Hello everyone, I just wanted to do a brief introduction to the audio from the 2019 CSSA show in Vancouver on my Western Canada update, as there wasn't a whole lot of introduction on it when I gave the presentation. So we have about 45 minutes of what's going on in the West from Manitoba West, a little bit of Ontario content as mentioned, and then some Q&A at the end. I've also put this into article form, and I will be posting that on my website and to LinkedIn and everywhere else. If you have any further questions, please email me at the email address listed in the article. Also, if you are interested in property tax appeal in BC, I know it's only end of June, and we don't really get on that until January, but we're getting a group together ahead of time. And we'd like to get as many people on it as possible. Sue from the CSSA should be sending an email out in the near future, but I'm just going to remind people here as well about that. So here is the recording from mid-June, I think it was June 13th, 2019 in Vancouver at the CSSA Western Canada Conference. Thanks. So if you're unaware, I put all these up on a podcast I run as well. So if you want to listen to this again, if you're not tired of me, it's on iTunes. If you just want to go back and grab some information, or if you have any questions, feel free to email me. I'm up here to do the Western Canada update because we are in the West. There will be a little bit of Eastern Canada content, but not a whole lot. Typically, I start in Manitoba and work back, save the best, or at least where the most people are from, for last. So without further ado, let's get into what's going on in the storage market in Manitoba. For the most part, it's pretty stable. The work that I've done shows me that occupancies in a lot of the smaller facilities are starting to rise. These are facilities kind of outside of the city core. I've done some work in a couple of larger facilities in Winnipeg recently too, and their occupancies seem to be holding steady. Rental rates, as I've said in previous talks, Winnipeg is the most rate-sensitive market I have ever worked in. People will drive for $5, they will drive hours to save money. So rates aren't really moving all that much. Some people, you'll see a facility try and get rates moving, and then their occupancies will drop. So everyone's just kind of staying where they are. We're seeing some new facilities planned or in the planning stages right outside of the city limits in Winnipeg, and this is partially due to that rate sensitivity. You can locate in one of the rural municipalities, pay a lot less property tax, get maybe 10% less rents, and draw from Winnipeg proper. And we are seeing some development in some smaller cities as well. So overall, the market in Manitoba is fairly stable. The economy seems to be relatively strong. Winnipeg avoided a lot of the downturn seen in the rest of the prairies just because they're more of a transportation-based hub, less oil and gas. And that seems to be holding true moving forward. So nothing super exciting in that market, but slow and steady wins the race sometimes too. In Saskatchewan, we have had some interesting things taking place. A few transactions in the smaller markets with a few more facilities coming to market in the near future. There is some action in Saskatoon, although nothing completed yet, so I won't go into too many details, but should be a transaction in that market shortly of a pretty nice facility. And for the most part, in the core areas, the occupancies are holding pretty steady. Saskatoon, Regina, they seem to be stabilized, most facilities. No one's setting the world on fire at 98%, but no one's really down in those 60% either. Rental rates have crept up in my surveys, probably about 4% the last year. Some facilities haven't moved at all. Some have moved rather significantly. So on average, it's about 4%. Smaller markets, we're seeing occupancies move up now. Your Moose Jaws and things down from that. We're sitting at between 65 and 70% last year, and now they're sort of 70 to 80% this year. That has to do with the improvement in the economy in Saskatchewan as a whole, but also some population increase as well. Saskatchewan continues to increase their population growth. with some economic stimulus and things like that. So we're seeing occupancies in the smaller markets pick up, and the core occupancies are holding at least steady, if not slightly increasing, depending on your facility. So overall, again, pretty steady market, a little bit of rental increase, a little bit of occupancy increase. Things look pretty good in that market, we'll say. Now Alberta, and this is going to take a little bit of time because we have to break Alberta into a bunch of different sub-markets because it's a lot different in a lot of different places there. If you are in Calgary and you would like to build a new facility, please be very cautious about what you're doing. There are a lot of facilities, 65 to 70% occupancies. They're Class A, well-managed, well-advertised facilities. The economy just isn't great yet. They elected Jason Kenney and the United Conservatives. Things are starting to turn around, but it's going to be an uphill fight in that market. Same with Edmonton. Edmonton's got a little bit more life with occupancy slightly edging up and some rents moving up slightly. But I would say if you're going to build any size of facility in Calgary right now, you need to plan on a 4 to 6 year stabilization period. It's going to take time to get going. Now, on the flip side, there's a facility out in Chestermere that I've recently done some work on that opened late last year and has seen incredible leasing. They're far ahead of where I expected them to be at this point in time, which speaks to some of these sub-markets being a lot better. I mean, Chestermere is maybe a 6-minute drive from the Calgary city limits, and they're doing great. But you come into Calgary and we have lots of facilities that are going to take, like I said, 4 to 6 years to stabilize. The Country Hills area by the airport, we got Maple Leaf with 154,000 rentable feet, and Public Storage has something around 100,000 feet that are both leasing. And although there's a lot of multi and single family development in that area, it's going to take some time. Then we go out to some of the smaller markets. Fort McMurray, conversations with some ownership and some management in there indicate my feeling of one of the 2 facilities in that market could close and everyone would be happy. That's how bad it is in that market. The fires took 10,000 people out of that city that have not moved back and won't for a long time, and their storage demand isn't there either. So we have occupancies probably in the 50% range, with rates having to be held steady, if not declining slightly. This has recently, with the Real Storage acquisition, become completely Storage Vault's headache. They own both facilities, so it'd be interesting to see how they manage their way through that. They're a very competent group, and it should work well. Red Deer, same thing. Their occupancies are in that 50 to 60% range in all the facilities. There may be a few small ones that are a little better, but it's just not a great scene. Rents are on the decline, occupancies are low, and it's not a great market, and that speaks to the overall economy in the oil and gas sector and how it just hasn't turned around. Then we look to other markets such as Medicine Hat, Dunmore Brooks, all these smaller markets, and they're doing great. I have a client in these smaller markets who has leased his newest facilities to 100% occupancy in 2 years, and is expanding and is looking for more land to build. Same with Lethbridge, occupancies are relatively good. There's an outlier there with a facility with a bad unit mix where they can't seem to lease their last 200 10 by 20s, but they leased all the small units within 2 weeks. So little things like that kind of give you blips in the market, but overall, a lot of these secondary and tertiary markets in Alberta are seeing a turnaround, and it's the major core markets that we're having the big issues with. And for the most part, we'll continue to have those issues until the economy does turn around. Just kind of on a note relating back to my last talk, Calgary had a big property tax issue with all of their core assessments dropping by between 20 and 70%. The Bow Tower, the big office tower there, was assessed at $1.3 billion 2 years ago, and this year came in at about $700 million. So you're seeing just how bad things have got in Calgary with examples like that. And although they're continuing to build multifamily towers, lots of single family stuff, it's just the economy isn't there to fill more storage at this point. It's going to take time. It's going to take new jobs. It's going to take new investment. And the government's doing that. And depending on what happens in October, and if we get our cardboard, plastic, paper, water bottle drinking, Prime Minister back or not. We'll see what happens with the Alberta economy there. I want to move from there on to BC. Now, we've seen some pretty good transactions in the Lower Mainland in the past, I guess, 6 months, maybe 7 months now. We had the sale of TransCanada, which is a Class A facility in Abbotsford, purchased by a local group who operates storage. Class A facility, 88-ish thousand feet, was purchased probably in a position there was some work to be done and purchased at a price related to that, but a cap rate of sub 6 in what I'd consider not a prime Vancouver market was really interesting to see, and that's based on stabilized. And then we also had Freeway Storage, which was in Vancouver, Class B facility with some management and occupancy issues, purchased by another local group. And if you want to look at an actual cap rate, you're looking kind of a 4.48. But like I said, issues with some occupancy, issues with some management. My understanding is that there's been a lot of work done and they're seeing great results there. So there's definitely upside potential for that ownership group buying it. Those two sales really kind of set a new benchmark out this way for cap rates and what people are willing to pay on a per square foot basis. And have actually caused a lot of you guys to give me a call about refinancing and things like that. So that was interesting to see. In the Vancouver market, we're seeing occupancies let off a little bit. I'm talking core Vancouver, so Vancouver, North Vancouver, West Vancouver, Richmond, Surrey. And what we're seeing in this market is that the average length of stays are shrinking by a couple of months because the unit rates are getting so high. In my last survey of rates, I saw more than one facility charging over $400 a month for a 10 by 10. And when I say over, I mean like we're talking $550 to $600 in a few of them. That's a lot of money for anyone to pay for storage on an ongoing basis. And this is the problem we're starting to run into in the Vancouver market, and we're seeing this in the GTA, is that storage is no longer the thing you just have on your credit card and that you get billed monthly, and that's that. Because it's so expensive for some of these units, it's something you're now using when you need it and moving out, which is a kind of a change as to what we've seen. The metrics that I've collected from a bunch of my clients is the average length of stay in the core Vancouver municipalities has gone from about 14 months down to about 11. Now this is different between Class B and Class A facilities, but that's kind of an overview. And that shrinking of the average length of stay pretty much correlates almost directly to the increase in price of units. So as storage gets more expensive, you're going to get more turnover in clients, and it kind of makes sense. As we go out in the valley, rates drop pretty quickly. If you look at facilities in the core, you're looking close to $4 per square foot per month. Once you get out to Abbotsford, you're kind of in that 2 range. You get to Chilliwack, you're at $1.75, and then beyond there, it drops pretty quick. So this average length of stay issue stops as the rates decrease very quickly. And in the most recent work I've done in Abbotsford and Chilliwack, their average length of stays are the same as they were 2 years ago, or 0.1 of a month longer. So, I mean, that's probably some statistical noise, but the same. Nothing's really changed out there from what I've collected. In terms of new builds, Vancouver, at present, there are at least 10 facilities in either late planning or development stages in the Vancouver municipalities. That kind of stops out in Surrey. There's a few others in Surrey that are being discussed, but haven't moved forward to any planning stages yet. So we're seeing a pretty big building boom right now, pretty similar to what we saw in 2008. In 2008, we had about, I think my count was 13 or 14 facilities built in Metro Vancouver between 2007 and 2009, so that kind of time frame, which is exactly this. And at that point, everyone said, oh, you're building too much, you're going to oversupply the market, the population growth isn't there, the metrics aren't there. And having appraised 7 of those 14 facilities in the last year, every single owner told me they wish they'd built more storage in 2008. So that's a positive thing. Just understand it's all about time frames. And those facilities being built are mostly Class A, multi-story, at least 50,000 feet, some up to, well, I don't exactly know how big some of them are going to be, but quite large facilities. And it speaks to the population growth in Metro Vancouver. The latest stats that Metro I don't even know what they call themselves, but Metro Vancouver's released is by 2040 they plan to add 2 million residents to Metro Vancouver. If we say in Vancouver, 4 square feet per capita, 2 million new residents, there's 8 million feet of storage demand coming in the next 10, 11 years. Well, there's no land to build all that storage, so we'll probably see rates continue to increase. We'll see occupancies stay high. And as these people come in, it's going to be tougher and tougher for them to find storage, and that probably works out well for everyone who owns stuff here. As we move out of Vancouver, go to the interior. If you are planning to build storage in Kelowna, please don't. I'm actually personally turning down feasibility work in Kelowna at this point because I feel bad for taking money to write a report to tell someone not to do something, and B, I just don't want to be involved in it. At present, there are 2 facilities that should be opening. I think actually one's pretty much there. And then there is also another 370-ish thousand square feet of rentable area planned for Kelowna. Kelowna's got a population of like 60,000, 70,000 people if you want to count some of the houses that aren't occupied. There is no need for that much storage to be built there. And a lot of it is you have people who made plans and they just continue on with it, or they're going to park money and plan to be in a long-term game here. But it's going to be a market that's difficult to compete in. I speak to some of the existing operators there, and they've run operations for a long time, and even they're starting to feel pressure on some of the occupancies and stuff. And this is without brand new Class A facilities opening in downtown Kelowna, which will be happening in the next 2 years. So that's a market that's a little scary. It's one of the few markets in BC that actually I have real concerns about, that we may get into a very big oversupply situation. For those of you who don't know, in West Kelowna, which is just the bridge across, there's a budget facility that's 178,000 rentable feet there, which is, by the way, like 95% full. But then there's also a U-Haul facility there that is incredibly large, or has a potential to be large. And then 2 new developments in West Kelowna. There are 2 developments in downtown-ish Kelowna that are going to be, one's going to be 70,000 feet, and another is going to be phase 1, 80,000, phase 2, 100,000. There's just, population growth is great, but it doesn't match. So if you're an operator in Kelowna, and I see a few of you that I know, if you're an existing operator, it's time to really make sure that your operations are good, your marketing is good, everything's running the right way, because you probably will be able to keep the people you have, because these new storage facilities, I've seen their pro formas, and I've attended some creative writing classes in my university career, and I feel that they may have been written there. So Kelowna's a tough market. Please don't build any more storage there. In Kamloops, we have a new Class A facility being built with a car wash right on Highway 1. Kamloops, the market's not as well served as it should be. Everything's pretty full there. It's fairly well controlled by Storage Vault at this point. Rates are moving up. Occupancies are 93% and above. There's a few places I surveyed that told me to call back in 2 weeks and they might have a unit, which tells you a lot of what's going on. The rest of the interior, rates seem to be increasing, not at a breakneck pace, but they're moving on the way up. Occupancies are relatively high. Not a lot of construction happening, and if it is, in Prince George, we're getting 10,000 feet of storage built, and a few other projects like that, where it's nothing that really moves that needle too far. But overall, the BC market occupancies and rates have been up over the last, we'll say, year since I talked to you last in this room. On the island, Vancouver Island, sort of the lower island, the CRD, like I mentioned in my property tax talk, we have incredible population growth in the West Shore, and we have one storage facility for sure going ahead, a second one that I would give a 90% chance of going ahead in the next year, and then a couple others being talked about. And the population growth in the West Shore is very robust. And the newest demographic stuff that I've been given for that market shows that it'll continue to be that way, and there's no issues with that storage market. As you move up Vancouver Island, Duncan and Nanaimo are a little less robust. The population growth is less. The economies are a little not as strong, and just they're not moving forward as quickly. There's a new facility planned in Nanaimo for the south of Nanaimo, and then a couple others being kind of kicked around. There's a new listing on Old Victoria Road, which is to the south, that it's two pieces of property that work as one. Full disclosure, I've done probably 4 appraisals and 3 feasibility studies in that one piece of land, and we'll see if it actually transacts, but there's a lot of issues with that as well. So overall, the markets in Duncan and Nanaimo, occupancies are still strong, rates are moving up. Not a whole lot of excess demand in those markets at this point. It's just well serviced and will be until the population continues to grow a little further. Then we move further up the island, and the same thing kind of applies. Your economy slows down a little bit more as you get further north. The population growth is less, the density is less. And again, occupancies are stable, but not earth-shattering. You're thinking 80 to 84%. Some smaller facilities with below market rates are 90 to 95%. But again, would you rather be 98% full at 20% below market, or 85% full at market? It's kind of a toss-up in how you want to run your facility. And we see that when we get into a lot of the mom and pop stores, where they're happy making the return they're making, so they're not going to do the hard management work of increasing rates and dealing with the customers and all that kind of stuff. And then I just kind of wanted to touch on, before I go to kind of questions, because I know there's a few of you who have questions who have already kind of approached me, just the overall storage market. We have the Real Storage transaction, which I'm sure some of you are aware of. If you're not, Real Storage was a portfolio of 38 facilities. I think it was 1 or 2 in BC, 11 in Alberta, and the remainder in Ontario. Storage Vault purchased that off Real Storage. I think it closed in April or May of this year for $275 million. Pretty big transaction. I think it's probably the second largest after the Sentinel acquisition a few years ago. I have been asked by numerous people about cap rates on this, and I'm not going to go into trying to analyze the cap rate on a 38 facility portfolio in front of everyone, because there's so many different things to account for and all that. I would suggest you just find Stephen Scott and ask him what he paid for it. I don't see him in the room, but it was a very good transaction. A lot of these facilities were in B markets, so your smaller markets, but it really kind of spoke to the strength of the overall storage industry at this point. With 11 facilities located in Alberta, I don't intimately know all 11. I know a few of them, and I know the performance of them, and there's definitely some upside as Alberta recovers in those facilities for Storage Vault to capitalize on. Anytime you buy a facility in like Red Deer that's very cyclical, or a few of those other locations, you have upside potential if the economy turns around. I mean, Real Storage did a great job of managing the assets that they had based on the market they were operating in. So I don't want anyone to think that they weren't doing a good job. It's just when the Alberta economy, especially in the smaller markets, tanks, you can only do so much. And then the most recent thing I wanted to kind of talk about briefly, it's not Western Canada, it's in Ontario, is the listing of Spaces Storage. 2 facilities, one at about 85% occupancy, one at 19% occupancy, so just in lease up, 140-ish thousand rentable feet. In the documents I've been given by a few people, there's no asking price, but conversations tell me between $108 and $110 million. So that's $770 a rentable foot. On actuals, about a 3.4 cap. We will see where this transacts at, but I can tell you that any work that I've done, just back of the napkin, is nowhere near that number. Now, if you look at the listing brochure, you'll notice the first 3 or 4 brokers have New York phone numbers, and then the last 2 are Toronto guys. So we may have an issue of guys coming across the line not understanding the Canadian market as well as they should, or thinking that they're going to get an American buyer for something like this. Do I think this is a good comparable for anyone in this room to use? Probably not until it closes. Is this going to set a new record for cap rates or per square foot in Canada? Probably. So it kind of speaks to the overall cap rate environment and what's happening. And I've stood up here last year and told everyone that stop overpaying for things. Cap rates shouldn't continue to compress, and yet they have. And I can tell you why. Every week I get at least 1 or 2 phone calls from multifamily developers or investors asking, how do I build or how do I get into self-storage? Now, to put this in perspective, I watched a transaction go through in Vancouver 2 months ago, 97-unit multifamily development, no rental rate increase upside. It's just an asset hold at a 1.97 cap. So if you're a multifamily guy going, I can get 1.97 on multifamily, which is pretty strictly regulated by the provincial government at this point for rental rate increases, or I'm looking at a 5 or above cap in self-storage, you're of course going to go, oh, this looks great. Not realizing that them wanting to pay a 4.5 cap makes everyone in this room go, why are you doing this? It's not worth that. To them it is. So we're having a lot of entrants come from outside of the storage world into the storage world, which is causing continued compression in a lot of our cap rates. In addition, we're seeing compression in the smaller markets because people are getting out of those same multifamily buildings and into storage facilities that are $2 to $3 million because that's an easy bite for them to take. You know, the number of people who can write a $108 million check for spaces, pretty small. The number of people who can write a $2 million check for a self-storage facility in, say, Vernon or Kamloops, that list is a lot longer. So we're seeing a lot of investors jump into that market as well, which has continued to account for a downward push in cap rates. In addition, interest rates continue to kind of be steady and not increase as we thought they might. Bank of Canada holds steady and occasionally chirps about maybe a slight decrease. We'll see. So that's what we're looking at sort of in the overall market. Cap rates are down. Rates are generally steady or up. Occupancies are, for the most part, stable or slightly up. And overall, everyone's pretty happy, unless you own just facilities in Calgary or Red Deer or Fort Mac. So at this point, I want to toss it out to the floor and see if there are any questions I can help people with in terms of valuation, market stuff. I don't want to get into what's a cap rate for my facility in this location. Just because A, it doesn't help everyone else, and B, there's a lot to discuss. So if you have that type of question, come see me after and we can talk through it. So at that point, any questions? Okay, I was like, someone's going to start this.
East Vancouver. So obviously, or Vancouver, we see a lot of facilities. Some are getting close to opening, and then we've got a bunch of others coming along. So it's a lot of storage, as you implied, a lot of demand coming on, and definitely I can understand the owners in the 2008 cycle. They opened up a lot of demand, and today they're all happy. But for a lot of those operators that are opening, particularly if they don't have any background storage experience, do you see them? Are they not going to have a lot of surprises through their rent up and their cash flow? And because I don't see them projecting or understanding that, one, because they're not in storage yet, and two, I definitely don't see it on their business plan very often.
Yeah, so interesting you bring that up. I mean, first of all, luckily the people in sort of that east part of Vancouver have the benefit of Burnaby not allowing any more storage to be built right now. But if you drive by Burnaby, there's, last count, 27 towers in construction. And I'm not talking like, oh, we're going to build a tower there. I mean, there's a crane building a tower right now. So that's going to be helpful, but I do agree. And knowing a fair number of those owners, they will all be or have been seeking third-party management help to get around some of those, because that is actually advice that I've even given them too. Like, You may know how to do a light industrial or a multifamily building. This is a completely different animal. Call someone who knows what they're doing. And for the most part, they are. So, yes, but.
I'll ask one more if no one's going to ask. Property taxes. Where do you see that going in light? Obviously, we're seeing a downturn in, I would anticipate a downturn in residential VC assessments happening in most communities just because the market is going down.
Yeah.
Yet on the commercial industrial side, I'm not seeing that. We're going the other direction. Mm-hmm. What is that going to translate into? Cities aren't changing their budgets for the most part, so they're still going to need cash. They've gotten used to this high level of tax dollar. Is that burden going to shift over to the operators?
I think what we've seen in a lot of municipalities, I know Vancouver for one, that split between the residential and commercial, they've realized that they've been burdening the commercial with a lot of it, probably unfairly for the last ever. And we see the increases now being shifted more towards the residential side. And if you take Calgary, for example, the absolute, essentially rebellion they had from commercial property owners this year when they tried to raise people's rates between 30 and 300%, you would get the same thing if they put too much more on the commercial side. Having said that, like you said, luckily the commercial side is increasing still in value, which should offset most of the residential decline, meaning the total assessment pool will be about the same. So as long as spending is kept with, there's a lot of ifs here, but if the municipality holds spending within their increase, then I don't see, at least in Vancouver and Metro Vancouver, a big burden, like an increase coming. There may be some other communities that don't have a lot of commercial, where they're very heavily weighted on residential, and that's declining, where you're going to have to see a shift towards the commercial. Of course, none come to mind at this point, but if you're in a municipality that has very little commercial activity, commercial real estate property, and a lot of residential, and you see the residential values slipping, they're not going to take pay cuts at City Hall. They've proven that to us time and time again. So they're going to have to find the money somewhere, like you said. And that's a situation where you could run into seeing increasing property taxes.
Can you comment to the extent that you've got any particular knowledge on U.S. interest in Canadian assets and how that's changing a little bit?
Yeah, I have a little bit of insight into that. I get contacted probably monthly by a U.S. group thinking about investing into Canada. None of them have openly pulled the trigger on that. There's some financing deals where storage groups have financed other groups and things like that, which, I don't have any concrete paperwork on that, but I've heard through the grapevine that there's been some of that. But there is definite interest across the border. Like I said, no one's really gotten to the point where they've pulled the trigger on anything yet, but there's been some pretty deep due diligence done by a few groups one out of New York I'm intimately aware of, a couple out of California, and it will continue to increase because if you look at the storage market in the U.S., a lot of consolidation, cap rates have compressed already. You have some markets where you're having rental rate decreases and occupancy decreases because they've built too much storage. And Canada luckily is pretty far away from that issue, except in a few markets, Kelowna. But yeah, there's increased, and every day it increases more. I run a just kind of information blog as well, and I see where all the hits come from, and the U.S. has become a much larger percentage of the number of people looking for information on storage over the last 6 months, we'll say.
I have another question if no one else does. Are you seeing any indication that any Canadian lenders in any of your appraisals, etc., are looking to push 25-year amortizations?
It's really lender and relationship specific at this point. We have some credit unions that will get very close to that. I've seen some 22-year AMs already, which, at that point, it's just kind of, you're almost there. But this speaks to a bigger movement in the market. When I started here about 5 years ago, I couldn't call any major Canadian bank and say, hey, I have a self-storage, person looking for lending. Can you be competitive? They'd put offers out. If you were a bigger operator, they'd help you. But a one-off, none of them wanted to touch it. Too risky, which I didn't really understand. And their argument was, well, all of your clients could leave in 30 days and you have an empty facility, which, although true, is not realistic. Now I have contacts at all the major charter banks, plus the next 3 banks under them, and credit unions in 4 provinces that actively contact me seeking lending. So if we're not there yet, we probably will be shortly. And it does come down to just the security of the asset. I mean, if you have zero storage experience, you've never done anything, and you just want to build 110,000 feet in downtown Vancouver, they're probably going to treat you differently than someone with 7 facilities and a 20-year track record. Those types of people are going to get the longer AMs. The new guys entering probably won't get treated as favorably. But loan to value up to 75% I've seen on big projects now. 20, 22-year AMs, nothing at 25 as of yet, but 3 years ago it was 15. So, that movement's been pretty quick.
Hi, I was just wondering, in all your analysis of storage, square footage and whatever, do you guys have any consideration for the mobile storage industry and how that impact is and how you see it going?
We do always look at what's going on in mobile and container storage in whatever market we're working in, just because it's a good thing to know. But we do find that there's a large portion of the population who just look for physical self-storage plan. Like, they want a building to put their stuff in it, and that's what a lot of our demographic research is based on. I have run into some markets more in the Maritimes. Charlottetown, PEI comes to mind because I've recently finished some work there. That there was a really large mobile storage and not a lot of self-storage, but that's shifting pretty rapidly. And the mobile was used so much because there were no other options. So it's definitely something we always look at just to see what's going on in the market. But at the end of the day, the self-storage user who wants a locker in a Class A heated facility is very different than someone looking for a mobile or container storage as well. There's price sensitivity, security sensitivity, things like that. So there is an overlap if you kind of draw the Venn diagram, but it's not that overlap, at least what we find in our numbers. Anyone else? Wow, very quiet group.
I'll throw out a question that may be a little a left field.
Okay.
What can you say or comment on any emerging trends in this sector regarding social enterprise? So I work at a charitable organization. I'm here because I want to learn about the sector, and I might want to buy a facility sometime and run it, and revenue just generates, strength for my own charitable organization. Is there anything you can comment on in that regard?
I mean, I always see the sort of the non-revenue units when I go through stuff, and I do ask questions, and we're seeing a lot of facilities giving a few units to social organizations. That's actually increased in the last 3 or 4 years. Other than that, I don't really have a lot kind of to add to that question. Like, it's a little out of left field, but I will tell you it's a great industry and it cash flows well and it's pretty secure. Everyone here is pretty happy with it, I think. So if that's something you're kind of looking into, it's probably a good thought for something that would drive a charity continually. But I don't really know what else I can add to that. Wow. This is shocking. I mean, I'm fine with it. We're a little early here, though. Any other questions that may not be related to what I'm talking about that might be valuation, feasibility, or general market questions you have?
This is actually top. I know it's a long shot, but would you have any statistics information on the West Kootenay?
I did some work for a facility in South Slocan about a year ago. And from what we found there, I was actually surprised, at how full it was for its size and the rental rates. Very nicely built facility. You probably have have seen it. It's West Kootenay Storage, I think. And yeah, it's one of those things where if you look at a tertiary market of, I think the facility is 50,000 plus feet of rentable space in an area that has a population of probably 15, maybe 20,000 people if you count all the areas around. And yet they've managed to fill this facility and another one to an occupancy level, which I was surprised about. So that speaks to just when you do feasibility work or when you look at things, you need to look at the demographics and the storage demand in that area because of the activities that take place there is much higher than would be expected just on the surface. I mean, if we say 3 square feet per capita as an average, which is too low now, guys, it's actually like 3.5 maybe, getting closer to 4 in Canada. You wouldn't expect 2 facilities in that area to be full, and yet once you factor in the fact that there's a lot of backcountry stuff going on, there's recreational homes, you're drawing from a much larger area, you're not 8 or 10 kilometers in this area, you're 20 to 50 kilometers just because of the lay of the land. It's one of those markets that was surprising to me when I worked in it and how aggressive the storage demand was. And then the prices achieved, some of them were very similar to some lower mainland, like Chilliwack or that type of storage facility too. So I don't have defined statistics, but that's just sort of my experience in that area. I do believe that facility sold rather recently as well.
In your talk number 1 today, you expressed an interest in putting maybe a little bit of a team together or interested parties to work on the property tax issue. During our AGM, it was expressed as well from the membership that was something that was important to membership. So maybe if you just have a moment to give us maybe an idea of what you see would be a good sort of layout or framework of how you see that a little bit.
So my feeling on this, especially with my experiences this year, one positive and one still dragging on with BC assessment, is that there is a complete and utter lack of understanding of our industry in the assessment authority. Anyone who's working on self-storage for BC assessment has been assigned from light industrial or somewhere else, and it's just like to deal with this storage facility. So I feel that our role needs to be one of education. We need to get in there and work with them on how to properly do their job, because right now they're not. But they're doing the best they can with what they got to work with. We're not the most open group when it comes to providing information, and that's fine. That's also our fault for telling you guys to literally shred those notices. And feel free to continue to do that until they get a little more threatening. They will send you a lawyer letter, and then you will have to provide if they really want to go down that road. And we'll see how much more aggressive they get. But I think we need to work on the education so we can help them actually build a proper model. Because some of the things I've seen, so the model that I've cobbled together by talking to at least 6 different assessors now in BC is everyone's at 90% occupancy. Is that true, everyone? You're at 90%. And I'm talking economic, because everyone's at market rates, right? So you're all economically 90% full today. Okay, so that's not true. You have no delinquent units ever. Everyone pays their rent on time. Your expense ratio is between 35 and 37, maybe 40% if you're lucky. Market rates, which is the highest competitor in your area. So if you're a Class B facility, you're having Class A rates applied to your facility. And they've just come up with an average and applied it across your entire facility. So let's say you have a facility heavily weighted to 10 by 20s. Well, that's great. They still think you're probably full of 10 by 10s, and they're going to say, no, you're not at $220 a square foot per month. You're at $290 because that's what we see over here. And then cap rates. This is great. And this is an example of what we're dealing with BC assessment. On the island, I have had conversations with one owner who had an assessment hearing right before mine, and then I had ours. This one owner who was before me has a Class A facility Very nice facility, well built, less than 10 years old. Yeah. On a main thoroughfare. The facility I was working on is 42-ish years old, in the back of an industrial park, Class B with deferred maintenance. Well, they're both 6.5 caps. And my argument to VCSF was, well, if he's a 6.5 cap, there's no way we are. So fine, you're right here, what are we? No, you're the same. And they don't have any way to quantify that. They also came to our meeting and said, we only have one sale, which is on Salt Spring Island. There's been no other transactions. And then I pulled 6 other transactions out of my briefcase. I was like, actually, here they are. So there's a lack of knowledge, and that's what I really want to get together. And then if we've educated them and they're still doing it wrong, then we have a united front to start fighting. Because what I really would like them to switch is from jurisdictional, the assessor in Nanaimo is doing the island, the assessor in East Vancouver is doing this, to provincial-wide, because at least that way we can all be treated the same. So that's what I sort of, Sue and I had talked, and I offered to spearhead the BC tax thing because my foot is firmly somewhere with them right now already. So that's what I see happening, which is why I kind of asked people to sign up. I'm sure we can send an email out if we don't get around to it today. So first education, and then if we're going to fight, let's fight together. That's what I'm proposing. I think Chris,
Yeah, one was a comment in front of the room. There are groups out there that do lend 25-year agreements. We were successful in negotiating a rather large facility with that amortization of 24 months ago. That's the comment. The question is on the development side for your feasibility type work, and also when you're valuing
So the question is, when we're doing feasibility work, how do we quantify, essentially, how do we get to our absorption analysis? How do we say, how long till you're at stabilized occupancy? And some of this is a little bit of the secret sauce that I get paid for. But a lot of it is doing demographic research, figuring out what we feel the overhang of demand is, number one. And then looking at other facilities. A lot of the time I have access to owners who are very helpful in sharing information at what their lease-up rates or what their customer churn and all that is. And we factor that all into sort of how we get there. But let's just say you want to build 50,000 feet and I do a feasibility study and there's 450,000 excess feet of demand, which does happen in some markets. I mean, sometimes you don't build for 5 years and you get, 20,000 people moving in and you get a lot of excess demand. We'll look at a lease-up period that would be much shorter, but at the same time, if you're kind of closer to being even with that number, we know it's going to be protracted. It's kind of hard to walk you through my entire analysis. It usually takes me a couple of days, but it's based on supply-demand, but then also current market stats, which thankfully we have some very good relationships and information sharing things with industry participants that help, And sometimes you get realtors who post how lease-up's going in new facilities. It's very helpful too.
Yeah, thank you, Patrick, for another great session and insights. You're definitely expert in the field of cap rates. So my question is, in terms of the general summary, are you able to give us what you think the 3 best investment locations in Western Canada are? And I'll write notes.
Well, the problem with that right now is we've been in this new building cycle for 4 or 5 years. So a lot of the best markets, there's 3 or 4 people in front of you already, which is the problem. So I really can't point out, case in point, where you should go. However...
Oh, come on, Patrick. Come on. Give us a tip.
Well, I can tell you where not to go. But if you look at like the Lower Mainland, if you're going to want to put a facility somewhere, you can find land in Port Coquitlam or the Maple Ridge area. That's a market that really hasn't really been built out yet. I mean, you have Fremont in Port Coquitlam, you have the new Storgard on the number 1 there. but there's so much development taking place on the farmland right there. Unfortunately, our friends at Self Storage Depot have made Langley not a go. But check out the renderings. That building actually looks really nice. And that's what I'm saying. There's a lot of, the problem is we're kind of at the end of this building cycle, so a lot of the places that needed storage have already gotten storage or are getting storage. So it's a tough one. Depends how big you want to build too. There's markets in the interior and even in some of the Fraser Valley that can take 25,000 feet or 30,000 feet. It can't take 150,000 feet. So I know you'd love for me to say build here, here, and here, but I got to know what you want to build, what your time frame is, size, all that kind of stuff. Having said that, population growth is the number one driver for storage demand at this point, and everyone seems to like to move to BC. So, wait a few years and see where everyone moved, and then we'll build storage there. I'm getting the eyes from behind me, so I'm going to sign off. If you have any more questions, I'll be downstairs.